Well, hello, everyone, and thank you so much for being here today. Really excited for this conversation. I've had the great opportunity of meeting Stephen Kaufman before, having him on the show last year, and had a wonderful conversation. I've been really, really impressed as I've kind of gotten to learn more about Zeus Companies. Today, we're going to have a very pertinent topic, I think, especially in this day and age, in the world we're living in, talking about this idea of, you know, there's building wealth and then there's also protecting your wealth, right? And with the volatility of the world today, I think finding assets that are really good to invest in, that provide some downside protection, that allow you to preserve your wealth and take care of it and help nurture it is really, really important. And part of doing that really well is finding people you trust that you can invest with. Stephen and his organization, Zeus Companies, have been around for decades now, have done billions in transactions in the real estate space, and have really kind of made a name for themselves as a trusted partner in the retail investment landscape. So I have a lot of respect and appreciation for that. I'm glad he wanted to be a sponsor here today to be able to dive in on all things preserving wealth and utilizing real estate as a way to do so. I think it's going to be an awesome conversation. So Steven's going to come on up here in a second and we'll get into the conversation. But please, as you have questions, feel free to drop them into the Q&A. We'll work to get to them before the top of the hour. And looking forward to diving in. Steven, thanks so much for being here today.
Yeah, thanks for having me, Chris.
Oh, it's a privilege. No, I have a lot of respect and appreciation for what you've built. For those who don't know you, can you just give a little bit of background on what Zeus Company is and who you are?
Yeah, I'll give a little background and I'll dig in more if you'd like. But I'm really grateful to be back with Kingscrowd. This is exciting. Zeus Companies, we're a private equity company located in Houston. We have about $1 billion under management. We really invest in debt and doctors, is what we like to say, real estate debt. And when we say doctors, we mean healthcare investments. A
Hmm.
lot of our investors are doctors because we invest in a lot of healthcare projects on the equity side. And on the debt side, we invest in real estate debt. And we've been doing that for about 25 years. And from myself personally, I was born in New York, but I've grown up in Houston. Congratulations to the Knicks if you're a fan. I had, I have a very dynamic background that is interesting to hear. Probably most notable is, my family is fairly famous because my uncle invented something that I'm sure you're very familiar with. If you look around the room you're in right now, Chris, or anyone who's watching looks around, you're likely going to see an exit sign. And when you see that exit sign, obviously that represents my family because my uncle invented that. And globalized that. And so I learned a lot of my business acumen from him. We're here today.
That's amazing. Well, I think something that your uncle and you have in common is that you find the thing that maybe a lot of people aren't even thinking about, right? That's just kind of the thing, but it's there and it's everywhere and it makes really good money. Um, so at Zeus Companies, you've been building for I feel like several decades now. As you mentioned, $1 billion in assets under management. Talk to me about your investment approach and style.
That's a great question. We don't get asked that question very often, so I'm grateful you asked me that, and I can really simplify it for you in three ways. And I wasn't even prepared for that question, but we want the perfect blend of safety, liquidity, and rate of return. And though those three things, depending on the investment, are all equally important, some investments put more emphasis on one versus the other.
Sure.
And so we want the perfect blend of all three of those. We love the quote by Mark Twain, who said, "The return of my money is just as important as the return on my money." So, protection of corpus or principal is critically important to our enterprise. We have, successfully, on the equity side, we haven't exited a transaction below 16% IRR in over
Hmm.
25 years. So we make it our business to blend safety. We'll make sure people's money is there when they expect it to be there. Liquidity, can they have access to it when they want it? And rate of return, does the rate of return we're getting for the liquidity and for the safety a perfect match? We don't even look for what's called outsized returns. And I'm sure you're familiar with the phrase. We don't look for a yield that's higher than those others because typically when there's interest rates are a reflection of risk. an interest rate, a yield is basically someone putting your entire risk profile in a single number. And so obviously the higher the risk or the higher the rate, the higher the risk. And so we're always looking for a very nice blend of that. And I guess the easiest way to say it is we're in a very unsexy business. It's a very boring business. Everybody else pays quarterly. They get these really big pops. They get really excited about all these great investments. But our note business, Chris, is pretty boring. You invest in notes, you get paid monthly.
Hmm.
You get corporate guarantees, you have insurance, you have all these other things that protect you. So it's a pretty boring business, to be honest. That's why being with people like you gets me excited.
So, I mean, 16% IRR, I would actually argue is quite good. And I think even in the eyes of the stock market can be outsized. Um, I'm sure you get this question sometimes, like it could almost feel too good to be true, someone trying to provide security and risk management while still getting very, very nice upside. So how are you structuring these deals
Sure.
to be able to drive that type of return?
I want to clarify when I said earlier 16%, that was on the equity side. On our debt side, it's usually between 8 and 14%, depending on the time in the market.
Sure.
I have a friend who works for a very large investment brokerage house that you would recognize immediately. My oldest friend, actually. And he once told me, how can you provide 8% when the market, in its best over a long period of time is providing, 11% in the public equity market? And it's really relatively simple, actually. A borrower pays us, and we take a spread from what the borrower is paying us to manage that portfolio. We fund the amount that the borrower is requesting. We underwrite it, we source it, we process it, we underwrite it. We do all the things. It ends up on our books as a company, and then institutions or individuals fully or fractionally participate in those notes. So they take all the note or a little bit of the note, and essentially we're just building in a margin to manage that note above and beyond what we're paying the investor. So our investor pays nothing. They get a pure rate. It's so simple for our debt investors that they get a 1099. They don't even get a K1. They're
Hmm.
effective. It's as simple as you're getting interest. You provide capital, you get interest, you get a 1099. Now, you're getting security, insurance, all these other things on the real estate itself, which I can get into if you'd like. But the yield is being, when we say 8 to 12%, in that range, when you're thinking about a fix and flip investor, you remember these home fixing like
Hmm.
HGTV where they take the ugly house and they show the big check at the end. Look what we did. We made a really pretty house. We made all this money. We're the lender who provides that capital. We have a lending company called ZeusLending.com that provides investors like that capital. And so for them, because they're making so much yield on the flip, for them, their debt cost is built in to be a little bit higher because they are taking more risk taking a house that's pretty ugly and making it really beautiful. We help
Hmm.
them manage that risk all the way through from the beginning to the end. And we pay our investors the after taking our split for covering our costs, we pay our investors the delta. They get majority of the return, and we take a
Hmm.
sliver to cover our cost, so that neither the borrower nor the investor are impacted by that transaction. It's very clean and transparent, and we do all the management, so it's really done for you.
Hmm. In terms of the investments on the platform, are these solo kind of single deals, deal by deal you're investing in? Is it a portfolio of investments, both on the equity and debt side? I don't know if you structure it differently.
On the debt side, you can invest in individual notes or you can invest in a pool of notes.
Hmm.
So you can buy one at a time. Some investors prefer that. A lot of investors, especially investors who've been with us for a very long time, and this is where it's important for me to say that 94% of our investors still invest with us today. They re-up their investment over 25
Wow.
years. And that's partly because for over 20, almost 25 years rather, we've paid monthly distributions uninterrupted. That's during the
Hmm.
dot-com, during COVID, and during the subprime crisis. Our investors were getting monthly distributions and the reason why investors really love that is because they get to keep their hand on the pulse of how well our company's doing versus waiting a quarter to be told, well, we're not doing distributions this quarter, we're going to do them next quarter. Well, we paid distributions every month and we have never not paid them for nearly 25 years rather. And
Hmm.
going back to your specific question about can you invest in a direct investment or is it a pooled? We let investors choose. Investors who are more confident in note investing usually want to be involved in larger buckets for different reasons. Investors who are just starting out usually will buy one or two notes, see how those go, and then they usually participate more as time goes on.
I know that, there's been a lot out there in kind of the private credit space, right? I think Blue Owl is one of the big ones, where people are trying to redeem and they're having issues with redemptions and there's concerns and all of that. Um, for your investors,
Liquidity. You one of the big three, right? Safety, liquidity, rate of return.
yep. And so liquidity matters. How does I know you're getting monthly payments, but if you want to redeem your investment again, both on the debt and equity side, how does that work?
Yeah, sure. So typically, if you're investing in a single note, your note, our note to you to pay you, and we assign you collateral, it's tied directly to the borrower's note. So when the
Hmm.
borrower, let's say, Chris, you invest in a $100,000 note that we already funded, the property's worth 200,000. We collaterally assign the lien to you, so you have a lien protection. Should we disappear, you are the first lien holder. You have a pledge against that collateral. And assuming you invested $100,000, when that loan pays off in 7 months, we pay you off. If you need your money prior to that time for a 2% fee, similar to a CD, we will do an early liquidation for you.
Hmm.
If you're in our fund, we have a passive income fund. If you're in our fund that invest in notes the same way we just described, but not singles, but in groups, we have a 2-year period where we want you to keep your money. And then after that 2 years, every quarter we ask you to take out 25%. So
Hmm.
by the end of the third year, all your money is out. If you ever want your money out in the first 2 years, of some or all, there's a 2% fee, and we ask 90 days to liquidate. So again, why 90 days? Because we're not expecting you to call us saying, "Hey, we don't want this note any longer,"
Sure.
especially a performing note. So we want the time to do the investigation, make sure that we can transfer the note, do all the legal work, and then transfer it out of your name, and we liquidate you. And that usually takes 60 to 90 days.
Help me understand the structure of your equity deals. Are you, buying medical offices? And is it kind of fix and flip on your own side? How long do you typically hold these equity investments? Would love to know more about that.
Yeah, sure. So on the healthcare, can you hear me?
Yep.
Oh, sorry. I just saw alert pop up. I apologize.
No
On
worries.
on the equity side, we invest primarily in healthcare assets, and this includes MOBs, ASCs, HOPDs, anything that's in the healthcare space primarily, or anchored by healthcare. So we've done multiple medtail developments where we have a retail
Hmm.
development that's anchored by a very strong medical tenant. And
Hmm.
oftentimes the medical tenant, not always, Chris, but this is important. This is something that makes our firm very unique.
Yeah.
We often own a minority interest in the operating healthcare company.
Oh, wow.
We usually will get that because we'll exchange the opportunity to do a development for a healthcare group in exchange for they get to own a significant portion of the real estate. We want to own a minority interest in the operating company to yoke the businesses together.
Hmm.
We've been very successful at that. And as you can imagine, healthcare is a very profitable operating business, depending on
Yeah.
the segment of the industry. And we're primarily in the outpatient emergency medicine space. And so back to the core point, um, we our hold period is typically between 3 and 7 years. We just exited an asset. I would be remiss if I didn't say this. We invested in an asset in 2019. We exited it about in March of this year. We went through COVID. I just want to remind you of COVID.
Hmm.
People forgot that we went through COVID. We went through COVID. We went through an eviction moratorium where we couldn't remove tenants. We went through a situation where we had supply chain issues where we couldn't even get things to fix our properties for about a year. We went through all of that. We just closed on this asset. I want you to know, we did the pro forma in 2018. We broke ground in 2019. 6 years later, we missed the pro forma. It's a $14 million project, by the way, the exit. We missed
Wow.
a pro forma by $12,000. 1/10 of 1% is what we missed the pro forma by. When we talk about precision underwriting, remember, we're a lender first. We created a debt company that then sold off notes. And so our unique skill, if you will, and it's also why we mentioned all of those asset classes, an ASC, an HOPD, MOB, all of those different types, because we are a lender first, which means we're an underwriter first, and
Hmm.
our unique skill is precision underwriting. So, as evidenced by this example I just told you, where we were, $12,000 off on a $14 million transaction, almost 7 years later. Um,
That's amazing.
During on the other side of COVID, as a matter of fact, and so our unique skill being underwriting means we look at a deal first as a lender. Would we lend on this deal? If we would, then let's look at it as an investment. And
Yeah.
and they are like I said, they're typically either ground up construction, or I didn't say this yet. They're either ground up construction specific for with a medical provider in tow. We don't build spec builds. We don't do spec development. If we were building a development for a physician or a physician's group, we would be building it for them, and they would already be a leased tenant. And then
Mm.
we're filling in all the other tenants around them as necessary if it's a multi-tenant project. And it isn't always multi-tenant, but if it is, we use them as the anchor to bring everybody else in. And that typically takes 2 to 7 years if you're doing ground up. And if you're doing, value add, then you're talking about 2 to 4 years in time period. But we
Yeah.
like the life cycle of a transaction to be a lot faster than other developers. And on healthcare, you can get out of projects a lot faster.
Mm. In terms of the buyers of your projects, you kind of have a select set of buyers that typically like to buy your properties, like, oh, these guys do great work, and then, they hand them off to us, or are you always kind of trying to find a different buyer?
We trust the market for our buying base. We don't have a limited buyers list in our. We do have people who have bought from us repeatedly, yes,
Sure.
but we don't put our eggs in that basket. We think the broader market is much safer to be betting on than that. And on the debt side, you'd be surprised on the debt side in our, we have about $100 million portfolio in debt. And it's always been about that size. It goes up or down, but it's never going to get much larger than that. And it's never going to
Mm.
get much smaller because we're very boutique. You asked about deal size. Our average loan size on our debt investment platform is below $300,000. And people think
Mm.
we're crazy for that. Like, why would you waste your time on a $300,000 loan? And something I learned from my uncle, the exit sign guy we talked about earlier, deconcentration of risk is one of the greatest guarantees to longevity. And
Hmm.
we are a dynastic thinking company. We are not doing this for the next 4 years. We think about the next 40 years. And because of that thinking, we make decisions that are aligned with long-term investments, debt. Philosophically, I just want you to know we're a little bit different in the way we approach things.
Yeah. Well, I mean, it kind of sounds like from everything I've been able to gather is that, you go a little bit slower, you stay concentrated on a market you know really well, and your secret sauce is not like some tech-enabled scaling approach. It's just being super thoughtful and consistent over a long period of time. That's
Yes.
that's what you do the boring things well, right? Is that a good way
Yeah,
of putting it?
no, well, yeah, really, I love that. I mean, we like to say that we won't make you rich, we'll keep you rich, because we offer a product again, in our debt platform is pretty boring for most people. I'm sorry, I started mentioning this earlier. I'll come back. I started mentioning that you asked the types of investors, the types of hold period, and so forth. On the debt side, you would be so shocked on a $100 million portfolio how few investors we have.
Mm.
Typically, because the families who invest in this product, they have been in it for over 20 years and they want as much of it as they can get because it's a very
Mm.
secured. There's a lot of transparency. So when you have security, transparency, monthly distributions, and the opportunity for emergency liquidity, and you're making about 8 to 12%, in most environments, that's considered a really good uh, sliver. For some people, it's really big, and some people it's pretty small of your asset allocation. It shouldn't be all of your capital, obviously, but if you are looking for, income producing investments that have a covered downside, they don't have a large upside, but they have a covered downside, and it's going to be in your, going to be literally what they call mailbox money. It won't even be in your mailbox; it'll be in your bank account, ACH, every month. That's what debt provides. So it's a really unique investment. Sorry, thanks for letting me go on that tangent.
No, please. And you did mention that you have some like family offices and larger institutions investing as well. Can you give it just a little more color on that? And I just think it's another way of helping people kind of understand, the level or grade of your platform as the
Sure.
other larger investors coming in.
Yeah, we have multiple family offices that have, multiple pools of capital with us for this debt product. And
Mm.
again, it's not all of their capital, but it's allocation for the income that they want that's predictable for cash flow for their business. all of these family offices are dealing with the same thing your investments are dealing with and mine investments. They don't have operating cash flow. When you're building a new building, you don't have operating cash flow. And so as an investor and investment group, we want reoccurring revenue. And that's what we get from this debt. We get monthly reoccurring revenue. And so our retirees, for example, Mike Hall, Mike Hall is 82 years old. He's been investing with us for over 20 years.
Hmm.
We are his retirement plan. And I don't mean that we're not all of his capital, but we are his monthly income. And we take that deadly serious. We stay up at night making sure we're doing the right thing for him. And we don't have a widget or a secret sauce outside of precision underwriting that we have learned over 25 years and 17,000 transactions. And when you do 17,000 transactions, you learn a lot. And thanks to AI, we're really able to analyze what has gone wrong and what has gone right and really true up a lot of the things that we thought, okay, we're doing the right thing for our investors. Let's keep doing it. And the things that have not worked, we've gotten those out. They're gone. And there weren't that many of them, thank goodness, or investors wouldn't keep coming back. So there are not a lot of investors. I would say probably sub 100 on a $100 million portfolio.
Hmm.
I would imagine our average investment's about 400,000 if I had to guess.
Wow.
And we have multiple investors that are over in the millions. These are the family offices.
Hmm.
We have a few institutional investors. Our notes are bought by institutions. We have an institution out of New York that has about $15 million, an appetite for our debt. And they buy our notes. They have about $7 million of our debt right now. So we have investors in Canada, we have investors in China, Israel, and Mexico. So thank you for asking me to share that. I'm really proud of that. Thanks.
No, that's pretty incredible. And then on the retail side, individuals, I believe your investment started at 25K minimum. Is that right?
We 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 start. We typically like to say 50,000,
Yep.
and but what we really like to say, one on one, we like to tell a family, start with first of all with the amount that you're not going to miss because this is an investment.
Yep.
Number one, it won't be in your bank account next month. You'll be making an investment. So you need to be prepared for that. Number one. Number two, we want people to, if they're going to buy a note, we want them to buy the full note themselves so they get to experience that. And so we typically want people to invest about 100. If they want to start for less, that's fine. But then they end up being pooled with us, so they're sharing a note with us. That note I used earlier, the property's worth 200,000. We made a loan of 100. You were going to come in for 100. Let's say you only want to come in for 50. Well, we already funded the 100. So when you come in for 50, you're basically sharing the note with us, and we pay you half the payment every month in a distribution. But and I will tell you, most investors start somewhere around $100 to $200,000.
Oop, you just went on mute.
Sorry,
There
I
we go.
apologize. Once they see it working, it's money making crack. But it's money making crack, but it's not exciting, and it's not, again, there's very limited upside, but that's because there's a lot of absoluteness on the downside, and because of that, our average loan to value is 63%. As I said, we've been doing this over 25 years. We've been paying monthly distributions uninterrupted for nearly 25 years. Stats like that are hard to beat. And
You said with AI, you were able to look at your 17,000 transactions. And while there weren't many, there were some things that came out that you felt like you could learn from. Could you hit on one or two like things that you identified in that data that you went, oh, okay, like we could better optimize here?
well, I don't know if my team would want me sharing this because this is like secret sauce right now that I'm about to say.
No, you can't
But no,
say
no, I'll
anything.
share. No, no, this is good. This is good. This is good. We're really privileged to have done business with 17,000 people and be able to look at their transactions and see what went well and what didn't. And interestingly enough, Chris, what we found was that the credit score rating system for how well people performed was a lot wider than we thought. So
Hmm.
let me explain. If you're like me, you probably think a credit score of 680, 720, 740 is really good.
Hmm.
And that's what we'd all assume. We're in the credit market. We'd say 720, 740 is kind of the gold standard. What we found at looking at borrower performance and investor performance and overall transactions was that the range was much larger, that someone with a 655 credit score performed as well as someone with a 715 credit score if other
Hmm.
variables were in place. So
Hmm.
that credit score was not the leading indicator, surprisingly. It wasn't even loan to value, surprisingly. That loan to value, so cash injected. Everyone says they have to have skin in the game, right? We know from the subprime crisis that when we did a postmortem on all those loans, Wells Fargo did a really good postmortem on all the foreclosures after the subprime crisis and realized their claim was that loan to value or down payment was the number one factor. In
Hmm.
17,000 transactions, we can tell you it was not the number one factor. It was not credit score, and it wasn't skin in the game. It was something
Hmm.
else. And so that revelation really has helped us in our underwriting and improve our underwriting with a lot more precision.
Yeah, that's fascinating. Very, very interesting. I have some like theses on what it could potentially be, but anyway, moving on. You're in a really good market. Obviously, Houston, I feel like has been a growing market for the last 20 or 30 years. Um, just curious to hear your thoughts since you are more heavily concentrated, right? Like pretty much in that
Texas,
area
we only
in
invest in,
Texas.
yes.
Um, what is your outlook looking, 2, 3, 4, 5 years out from now? What are your guys' thoughts on the continued growth of Texas? Are there certain markets? Are there other ones that aren't doing as well?
Yeah, this is a great question. First, let's talk about Texas real estate. We don't get the appreciation or the respect that you're going to get in Miami, LA, New York, Chicago. Why not? Because we don't get runaway appreciation. You're not going to buy an asset in Texas and it's going to, like a Miami condo, it's going to triple in value in 3 years. But then when the market turns, it's going to be worth, pennies on the dollar.
Right.
I like to say that Texas real estate is synonymous with a quote that I like by Abraham Lincoln. And President Abraham Lincoln said, "We may walk slowly, but we never walk back." And Houston real estate may never appreciate it 30%, but it's getting a solid 3.5 to 7% every single year. And if you
Hmm.
check me on that, you will find out it is every single year. And so when you look at them again, we're not in the get rich business. We're in the staying rich business. We help investors stay wealthy, not get wealthy. And we help them stay wealthy by offering them two investment products that are, again, not sexy, not a lot of high risk, but a lot of covered downside with the appropriate yield and appropriate liquidity. And so Texas real estate, the Texas economy. Let's talk about the Houston economy. The Houston ship channel after COVID is the number one ship channel in the world.
Hmm.
If you look at LA, New York, Louisiana, all three of those ports combined do not produce as many imports and exports as the Houston port does.
Wow.
So that's how much activity is coming through the city of Houston. And then when you look at Austin and Dallas and Houston combined, our economic output over the next 10 years will be the greatest of any other state in the country, more than
Hmm.
California and more than New York. So we are positioned to be an amazing place to invest, an amazing place to live. More people will move and migrate to Houston, Texas than by 2030 than live in Austin, Texas right now. That's how big our city in Houston is growing where I'm located right now. And so more
Wow.
people than live in Austin are going to be moving here. So from a real estate and jobs are an old school, when we talk about old school kind of underwriting, old school real estate rules, um, jobs and real estate are directly correlated. You have to have jobs to have real estate. And
Hmm.
so we are creating jobs here. We are the country's leader in job creation in our state. And so that's why our real estate is going so well. Why did Elon open his largest data center in Texas? Why is Amazon opening their largest data center in Texas? Why is everybody opening their largest data center in Texas? Because it's an amazing place to do business. We have amazing land, lots of it. It appreciates at a very consistent pace and doesn't really have big ebbs and flows. So it's a very predictable model. If you're a dynastic thinker or long-term thinker in your investment strategy like we are, that's very important. We'd rather a consistent 5% than a 25 every couple of years. And so it really helps when you're strategizing on your family's wealth and long-term wealth preservation to be in a place that's very stable like Texas. So if you're not going to invest in debt with
Hmm.
Zeus, you should definitely invest for sure in Texas real estate. Chris, I have to say this. We did create a note investing guide. In fact, the five pitfalls of real estate note investing, and I wanted to offer that to your audience. Can I do that?
Absolutely. Yeah, that'd be
So,
great.
okay, great. So if you go to zeuscompanies.com, www.zeus, Zeus, like the Greek god, zeuscompanies.com /Kingscrowd. We have the 5 points of failure in note investing. It's a really, really helpful tool. You'll be blown away by the resource, I promise. It's not
Hmm.
like a one-page flyer. We did a
Yeah.
really great job of providing a lot of data. If you're going to be a note investor, whether you're investing with Zeus or anywhere, you should really look at this investment product. Anyone who doesn't have this product is crazy, because if you have liquidity somewhere and you semi-liquidity, meaning not your operating cash, not your emergency money, but if you have an
Yeah.
investment portfolio with an asset allocation, whatever your asset allocation is for your money market or your CDs or what have you, where you have this money tied up that you want it if you ever need it, but it's not your operating cash flow, you'd be crazy not to be in this product, paying 8 to
Hmm.
12% collateralized. I mean, that's insane. Monthly distributions, that's crazy. So even if you're not doing with us, please look at it yourself and everyone else, and you can look at those 5 points of failure that we provided. Again, that's Zeus Companies, Zeus, ZeusCompanies.com/Kingscrowd.
Awesome. We will
Thanks.
definitely
Thank
check
you.
that out.
Thank you.
No, that's awesome. I love to hear it. And I actually want to hit on one other thing regarding the market. You talk about um, on your equity projects, a lot of it is kind of like medical buildings, ambulatory surgical centers, all that kind of stuff. And then on the debt side, it sounds like a lot of like home flipping loans. Are there other segments of the market that you're interested in, whether it's, commercial properties, multifamily home, apartment buildings,
Yeah.
offices that you're interested in or partaking in?
We have a portfolio that is fairly mixed with some of those assets, but that's not our focus.
Hmm.
Those were opportunistic opportunities that throughout our career have come up, but that's
Sure.
not our focus. And we're a very disciplined organization, and we stick to our knitting. We as they say in Texas, I don't know if they say this everywhere, but you should dance with the woman who brung you. Do you know that phrase? Dance with the woman who brought you. Dance with the woman who brought you to the dance. You don't get to the dance with that woman and then go dance with somebody else. That's what we say in Texas. And so we pretty much stick to what we know works. And
Yep.
we have a good track record of knowing it works. We know that it's recession resistant. And you mentioned healthcare. The like debt, we're always looking for recession resistant assets. And healthcare is being one of those. So
Hmm.
and people want the opportunity to invest in healthcare. They just don't always know how or who. And being
Yeah.
that that's our specialty, it opens the door for a lot of families who don't have access otherwise to invest in these projects.
Hmm. When you look at the office segment, I know it's not your segment, but even in Texas, like what are your thoughts there? What are you seeing? I know like there are places where offices are going for pennies on the dollar. Is that the case in Texas as well, or is that still
No,
doing fairly well?
there. I think. By the way, we have office buildings because we have medical office buildings, and so they're impacted in the same way. If you have a office building filled with doctors, they are impacted the same way as an office building filled with engineers. And so
Hmm.
we understand the office market. And similar to multifamily, it's been obviously depressed since COVID and the work from home initiatives and things like that. What I would say is there are markets where submarkets in most major cities where office is actually doing well. In
Yeah.
particular, our focus is what we call boutique office, which is
Hmm.
50,000 square feet or less.
Hmm.
And so our medical and office buildings are doing well, very well, because we have very low concentration risk. Again, we're a very risk adverse enterprise. So we have very low concentration risk because these are much smaller buildings. They're more boutique. They're work where you live kind of, family office, law firm, engineer type product if it's not physicians. And so about 60% of all of our tenants across every asset are physicians. So
Hmm.
that'll give you a sense of our focus. And office is definitely depressed in Texas. There's been a movement to take office and convert it to multifamily in some major cities. I think that's been modestly successful. I don't think it's been a big movement, as you can tell, or it would be everywhere already if it was that good.
Sure.
So I don't think that model is probably going to work long term. I will say we know multiple groups nationwide, if I may, who are now buying office
Hmm.
because they believe aggressively the better asset, if you can buy it for below basis to build it
Sure.
in a good location, that it is only a matter of time before it gets back in favor. I don't have a crystal ball. And, I do know the further in the past you look, the further in the future you can see. Office has not been depressed in, any economic time that I can see that I can look back and reference. So I don't have a reference point to say whether it's going to return or not.
Hmm.
I'll just say much larger multinational investment groups are buying up office right now
Hmm.
because it is at the bottom in theory, and there seems to be a lot of opportunity in the space if you believe it'll eventually turn around.
Hmm. One thing I just want to mention, please drop your questions in the Q&A section. I'll be more than happy to get to them before the top of the hour. Um, I did want to ask you though, in terms of sourcing your equity projects, are these dreamed up by you all? Are these people saying, hey, we want this medical building here and we're looking for a partner? How does that typically work?
Yeah, it's typically one of two ways. Number one, a physician has never owned real estate. A physician or physician's group has never owned real estate. They've been leasing for 5, 10, 20 years. They realized how much money they've thrown away at one or multiple
Sure.
locations, and they want a friend to ask advice to. And they typically get introduced to me, and I advise our firm, and we advise them on how to proceed at buying their first piece of real estate for their
Hmm.
business, their practice. Either that situation, or the more common situation is they already own real estate, but they want to continue to expand, and they're at their capacity. They know they could do it if they had all the time in the world, and they could get the knowledge to do it if they wanted to, but they'd rather have a partner that they can trust, that is credible, that they can rely upon, that would do that work for them. That's the
Hmm.
more common. And so we usually become the real estate arm, if you will, of some of the groups and help them develop additional real estate projects.
Got it. I know there's also been kind of this large private equityization of the medical space, medical groups, ambulatory surgical centers have definitely been bought up by PE shops. Um, what are their thoughts on kind of like owning the building? Like, I imagine they're a little more
Great
business
question.
savvy.
You're so Chris, you are always ahead of the questions, man. I really am impressed with how much in the market you really are. That's a great question. And not surprisingly, most PE firms don't want the real estate. This is part of the reason why a
Hmm.
lot of CEOs want the real estate, because what they want, a lot of the executives of medical groups want the real estate because they know they're going to sell out eventually to a PE group. They want a lease in place already for their real estate that they own, and they're going to keep their practice as a tenant there for the next 20 years while they already sold their practice. So
Hmm.
it's a belt and suspenders kind of investment strategy. You're going to sell the actual practice. That's where your big multiple is going to come. That's going to be great. But this kind of long term a residual income annuity of sorts becomes the real estate that you own, and you can't go and buy it later. You have to own it when you're
Sure.
selling out. And most PE firms don't want the real estate, so they stay totally out of that business.
Hmm.
And that leaves the ownership group to be in a much better financial position when the deal is done, because now they have a long-term lease for the tenant of a business they don't even own any longer, and that becomes again true mailbox money for them because they have this tenant money from the PE group.
You talk about long-term investing. So I'll ask a question. I'm sure the answer is yes, but utilizing IRAs and retirement funds, is that something you enable?
We do about 70% of our investors invest through a qualified plan of some sort. We
Hmm.
highly recommend, if you don't already doing that, moving that way. And uh, the Chinese proverb goes like this: when's the best time to plant a tree? If you don't have an IRA, that's no reason. If you don't have a Roth, or you don't have an IRA at all, especially if you don't have a self-directed, just because you don't already have one and you've already become successful or you're already making investments, to not have one now, that's silly. It's I don't know a great metaphor for why, that I could use here to say just because you didn't do it before, you shouldn't do it now. No, you should do it now. When, as the Chinese proverb goes, when's the best time to plant a tree? 20 years ago. Yes, you should have had your Roth self-directed 20 years ago, but you didn't. So what's the second best time to plant a tree? Today. So get a Roth today. And if you, we have resources, guides that we can share with you on how investors have transitioned to having zero in a retirement account to having a majority of their net worth in a retirement account, in a period of time, in a very short relative amount of time, and how the strategies they used, including those of Peter Thiel or Mitt Romney or other people who are very famous who've discussed these strategies openly.
When you look at your investor base, you
By the
know,
way, can I say one thing?
please.
If you're not thinking about taxes and tax strategy, or you're treating it as though something you're going to get to later, the effective tax rate in the United States has never reduced in the history of the company, in the history of the country. It's never gone down. And I don't know what the average one is now, effectively across all taxpayers, but I'm guessing it's somewhere about 25% on average for everyone. Just think about that. For every, you're we're talking about a yield earlier. You said 16% was pretty great. If I'm talking about making 8 to 12% in debt, all of these sounding like great yields, but people don't even blink an eye paying 25% in taxes as their
Right.
effective rate. So this is, this your spent expenses more than you're even going to get as your yield. So it's a conversation we think more investors should take a lot more serious.
Well, you mentioned something about getting a 1099, not even a K1. Is there any like depreciation benefits or anything from a tax perspective that folks can get investing in
on
this?
on the equity side, of course, but on the debt side, it's so simple. There is no. It's
Right.
really, really, really pure investment. Get a return, get a 1099, and you're complete. Most of our investors prefer that because it's very clean and very fast. If you're waiting for your K1s, in June or July, still of this year for investments, imagine you would have had your 1099 from us before the month of January was over.
Mm.
And so investors really love and the simplicity of that. Again, it's boring. There's not a lot of numbers. It's a one-page document, not a three-page K1. We said it's boring because you get monthly distributions. It's real transparent. It's just really clean.
Do you accept all IRAs? Just because I know sometimes like they could be very convoluted and old school. So the idea of like getting a monthly distribution, like how they even accept that from, an online platform, how does that work?
There's not, we've never had an issue that I'm aware of on
Great.
the different types of platforms that investors are using for their IRA. Who their custodians, most custodians that we have ever worked with are fine. I don't know of any situation I can recall where there wasn't a custodian that didn't work with our product. And we work with the largest groups that you can imagine, including Inspire, Direct, all of them.
Got it. And in terms of, kind of estate planning and what have you too, like being able to have it, whether it's in a trust or some transfer vehicle so that, when you pass, you could pass it on to your kids or whatever it may be. How do you support and help in those things as well?
Yeah, that's a great question. We don't direct any strategy, but we're very good order takers. So if you tell us a strategy and give us orders on what to do to execute the strategy for you, we'll do it. And so, absolutely, we have families that want money in their family living partnerships. They FLPs, or they want money in some sort of trust for their children, or all of those things. We have lots of investors actually who have all sorts of very complicated tax strategies, and we can accommodate them. It's just account styling. It's no big deal to us.
Sure. Yeah, no, 100%. Um, you did mention that, you kind of try and keep things around a certain size because frankly, that keeps the quality up and the returns up. Um, so in terms of kind of managing that, when you look at like the number of equity projects you have out at any one time, what does that typically look like?
Oh, that's a lovely question. Also, we typically invest in 1 to 2 transactions a year.
Got it.
For most groups, they want to do one a quarter or one a month, but I want to explain the difference between our note and equity business. And we're in the business of making investments, and we want our friends to make them with us. New friends, we'll say, Kingscrowd friends. We're making the investments first ourselves. So there's not going to be a debt transaction that my firm hasn't funded with my own capital first.
Hmm.
So we trust the transaction. Our own capital is what is funding it, that transaction. So we're making an investment, and then we're asking our friends and family, do you want to participate in this investment with us? If you do, great. If you don't, it's okay. That's also why I said our investment group is very small, less than 100 people in total for $100 million debt portfolio and $1 billion in real estate assets. It's still less than 100 people in total.
Mm.
If you include the family offices as well, just the principal of those family offices. So um, we're um, um, sorry, will you ask me your question? Bring me back to that.
So, in terms of the number of projects you take on
Oh,
each year.
1 to 2 a year. Because thank you, 1 to 2 a year. Because we're not in the business. We're not in the business of making investments. That's not our business. We make investments, and then we ask people if they want to do them with us. That is a very big difference, and it's a nuanced difference. But if you are thinking about preserving your family's wealth, you should hear the difference again,
Sure.
because our duress is different from other groups. We are not in duress to do transactions to pay people. We don't have a large operating company where we have to pay 2,500 employees every month. That's not how we operate. We're a very lean company, and you would be surprised at how much we manage Well, you understand how much we manage, but how many people we use to manage that. And um, so I think for 1 to 2 a year is a number that enables us to be selective. If we get lucky and we find more than two, I'm not saying we won't look at that. We have done more than two in a year. But if we don't do a transaction a year, we're not upset. We don't want to do a transaction just to do one. We're looking for good investments that we want to make. And if we find one, we're going to make it. We're in all of our equity transactions, we are either, I think all but two, Chris, historically, of every equity investment we've ever made, we are the largest investor in that investment.
Hmm.
So every investment, we have the largest capital exposure. Why? Because I just said we're not in the business of doing investments. That's not what we do. We don't do debt. We have a debt business because it's easy to explain. But the truth is, we're making investments in debt. And then we say to people that we know, Chris, check out this debt investment. We like it. You might like it as well. And the
Hmm.
people that we've done that to over the last 25 years, 94% of the people who've said, yeah, I like them, I like this, have kept doing it. So we might be onto something.
No, absolutely. In terms of those equity projects that you take on, what is the average size of those deals? Are they 20, 30, $40 million or smaller, bigger? And how long does it typically take to develop those projects?
Uh, Development time typically takes on the size of the project,
Sure.
and development are larger. We've done two projects that are about $100 million each.
Wow.
Our average transaction, if I had to guess, I would say is about $15 million,
Nice.
maybe 20.
And then once you kind of take a project on, do you work with a separate like development company to actually do, the design and development of the property, or do you have that in-house?
No, the design is a hybrid method. We have our own method that we use, and then we use an outside architectural firm. And then on the construction side, we don't own a construction company. We put that out to market for bid, and we made the best company win. And we have vendor trades that we've used for many years, and we put it out to bid. Every project, every time goes out to the market for bid, so we can get the best pricing. And then we manage those vendors in a very, very, very tight way internally. So all the management of the project is done internally, including
Hmm.
by me. I physically visit sites that are under construction myself, actually. Not every day, but very, very regularly.
And just out of curiosity, do you ever kind of play both sides of the deal where like you're coming in as the equity investors, but then take out debt from
Great
Zeus to be
question.
able to?
Great question. We have covenants that don't allow us to do our own debt, so we can't do that. But in addition, remember our average loan size on the debt portfolio is only about 300K,
Yeah.
and we only invest in single family houses because again, our main focus is deconcentration of risk. We don't mind that all the loans are $300,000 because if any one loan goes bad, it's no big deal. You do
Yep.
a couple, you do three $30 million deals, and one of those goes bad, you're in really big trouble as an enterprise. But for us, if deals go bad at $300,000, we absorb that and keep moving. So it's a lot more work on our side, but the work is in exchange for the reduction in risk to ourselves and our family and friends who invest with us.
Well, you mentioned on the debt side that you looked at your 17,000 transactions and found some, areas where you can improve. On the equity side, I'm sure based on what you're talking about, you haven't done a ton I mean, you have done a ton, but not 17,000. But are there any learnings along the way from there too, where maybe a project didn't go as well as you wanted and things that you've learned on the equity side?
Yeah, that's a lovely question, and the answer to that is yes. And on both sides, we're always learning. We're always learning. And on the equity side, we definitely have learned a lot. We had to deal with things during COVID we've never had to deal with before.
Mm,
Do you complete a project with if you have all the door handles in a building are, typically the same door handle. But during COVID, we had to make a decision. We can't get all the same door handles for a building anymore.
mm,
And we can only get half or a third, or we can't get, we know a multifamily developer who he couldn't get matching appliances for his
mm.
multifamily development. And so he was having to decide, what does he do with these? I think learning how to make decisions fast is probably the thing we've learned during COVID. That's the most
Yeah.
important, that we don't have all the information, but we still need to make a decision and we need to make it quickly. I think learning how to make fast decisions in a safe and efficient way is probably the thing that COVID taught us the most on the equity side,
Mhm.
because you're pivoting very quickly based on market conditions that you are have no control over, and you don't know how long they're going to last. Now, that being said, I have to go back to the last transaction, equity transaction we just exited, which we exited after almost 7 years. Started in 2018 pro forma, exited in March 2026 with a $12,000 difference on a $14 million exit. I didn't say this earlier, but we actually exceeded the revenue pro forma by 27%. We brought in
Mm.
27% more revenue than we projected, and we exited at a sales price only $12,000 off what we
Wow.
projected 6 years ago. So precision underwriting matters, and learning how to make those decisions very quickly is what we've learned the most.
So the 27% greater revenue than you had expected, does any of that get distributed to investors or do they only partake in the actual exit?
No, no, they own the asset along with us in their equal share, and they are riding that wave all the way up. We're a very transparent company when it comes to profit sharing and profitability. So no, they were handsomely rewarded, an incredible IRR
Nice.
for all of them.
Yeah, that's awesome. Um, when you kind of look to the next year or two, I know we talked a little bit about Austin, Houston, Dallas, and really just the overall Texas market. But are there any specific cities or opportunities you're getting really excited about that you're potentially thinking about going into the next year or two?
Do you mean outside of Houston or
I
outside of
just
Texas?
Yeah, yeah, no, in Texas, but just in general, like, is it Austin you're most excited about? I know Dallas is growing like crazy. Like,
Yeah.
are there any markets and opportunities you're really excited about?
But this is the one of the first times the Houston market has outperformed the Dallas market
Hmm.
in modern time, and
Wow.
I'm really excited about that for the city of Houston.
Yeah.
So the fact that Houston's being so resilient during the economic turmoil that other cities are dealing with, I'm most excited about the city of Houston. Just what's
Hmm.
happening here is pretty amazing. It's really the epicenter of a lot of economic activity in the entire country. And so to be where it's happening is exciting. And so investing anywhere else to us right now seems not smart.
Yeah. Um, for investors who are listening into this, if they want to get started, they want to go make their first investment, where should they go? What should they do?
I think if they're going to make a debt investment, you really, really don't want to make a debt investment without checking out those 5 factors that are kind of like the 5 pitfalls that no investors make. And so you can get that by going to our website. I said this a couple times. Can I say it
Yep.
again? Okay, great.
Please.
ZeusCompanies.com/Kingscrowd. Zeus, like the Greek god, Zeus Companies.com/Kingscrowd. And you'll get our 5 points of failure write up guide that we made for real estate note investing. Keep in mind, you don't need to have that guide to invest with us. You should just take that guide and use it if you're going to invest
Yeah.
in notes. And I am telling you, you want to invest in real estate notes. The credit market is fantastic. And so, what they always say, it's better to be the bank. This is your chance to be the bank. And so that's what we're recommending.
I love
And
it. I just dropped the link in the chat for folks to be able to check out.
thank you.
And then if they go on the website, can they also check out the equity investments directly on the
They
website?
can. They can. At ZeusCompanies.com, they can see all the things that we have to offer
Terrific.
there. Yeah.
That's awesome. Well, I want to give you the last word here. Anything else folks should know and walk away with?
Yeah. I think if you look at, from, the Epstein files to aliens to COVID to everything else going on in the world, I think anchoring to things that are predictable and safe and secure um, is really valuable. And there is probably more uncertainty in the world, I think, today than has been in most of my life. And I think having investment vehicles that are safe, semi-liquid, have a matching rate of return with a, a group like ours or any group that's been doing this, that's been tested. You want to invest with a group that's been tested.
Mhm.
And this is just such an amazing asset class. Again, it won't make you wealthy, but it'll keep you wealthy.
I
And we're
love
excited
that.
about it.
It kind of reminds me of the PNC Bank commercial that's on TV these days, right? Like notoriously boring since 18 whatever,
Uh,
and saying like be safe with your money, do safe things, right? And I know there's all sorts of crazy and exciting strategies, including things we look at, which is investing in startups, right? Which is a crazy idea. Sometimes it's amazing, sometimes it's terrible, but balancing your portfolio and finding things that are notoriously safe and old school and all of that is a very thoughtful, good thing to do to diversify your portfolio. So I have a lot of respect for what you guys do. I love that you're just consistent, doing the right things the right way, and giving people an avenue to kind of, protect and take care of their money. So, Stephen, as always, what a pleasure to have you here today. Thank you so much. Congrats on what you've built. And definitely for those who are on here, you can check out the chat. We dropped that link that Stephen was mentioning. And I do think you should certainly check out Zeus Companies. Again, I have a lot of respect for what you guys have built. Thank you, everyone, for listening today. Thanks for your questions and time. Hope you all have a wonderful day and look forward to seeing you on future sponsored educational webinars. Have a wonderful day. Take care, everyone.